trash right here.
I've got one goal when we're done today, and that is I want you to think of your business as not you. And I think that may be really hard because a lot of your self-identity is wrapped up in your business. A lot of the work that's done in your business is done by you. But when it comes to financial management, you need to think of yourself outside of your business. Think of your business as something that is accountable to you, that you manage, not something that you do. And so in the end, my goal becomes this: to teach you a few things today that will start a lifelong track for you to understand how to maximize the amount of money that your business owes you and never run out of cash. And at a really simple level, for any business as big or as small as it can be, it's got these same goals. Maximize the amount of money that your business owes you in the long run and never run out of cash. You may wonder why I add the never run out of cash. Yeah, cash is king. This is the #1 reason when you hear all the statistics about businesses no longer existing, it comes down to managing cash. But there's a lot of businesses that find a way never to run out of cash, but they wallow in mediocrity and they never give you what you want to get out of them. That's why the top part is in bold. So one of the first things that I want to talk about this morning, before we even go into the idea of how to maximize the amount that your business owes you, and also never run out of cash, is the idea between learning and performing. I think so much in our lives, we think that learning ended when we got our either high school diploma or we got whatever advanced degree that we might have, or we finished an apprenticeship, but we forget that learning is something that we need to focus on throughout our lives. And in fact, if we spend too much time just performing and doing what we're doing every day, we actually plateau and sometimes move backwards in terms of our performance. So before we even talk about the idea of how to manage your business, I want to get a little bit of a paradigm shift in your brain in terms of how you think about learning about financial management. And part of it is also, I want to commend you guys for making the time to be here, to walk away from the day-to-day operation of your businesses, and to be here at a convention where you are in what I call the learning zone. So here's what I want to hit on before we move on to the next point here. And bear with me while I come back over here. Close that. Grab this. Perfect. All right, so what I want to make sure that we don't lose after watching that video is the idea of having a learning zone and having a performing zone. And when I talk to small businesses about managing their finance, typically one of the reasons they're having an issue is that they're always in the performing zone. They always feel like they're behind on their finances. There's words or jargon that they don't know. One of the easiest ways for me to clear a room is start talking about debits and credits and budget and depreciation schedules. People in my office just walk away and they say, that's no fun, I don't want to talk about those things. So part of the reason people say that is that they're in their performing zone. They're saying, wait a second, I need to do my daily job, so all this new vocabulary that you're giving me is overwhelming. Well, what I'm going to invite you to do is step out of your performing zone. Don't think that you have to do anything right now, and be ready to accept some new vocabulary. And if you take a look at some of the other things that he talked about that I really want to stick with you is, one, instead of in the performing zone where you've got to do something from A to Z, take some of the things that I'm going to talk to you about today and other things you've learned this weekend, break them down into some fundamental things that you can do and practice to learn. The game that you guys played yesterday is an incredible tool for that, because it allows you to make some mistakes that don't count in the real world, learn new vocabulary at the same time. The second thing that he talked about was pushing yourself beyond your comfort zone. And I know for a lot of people, finance can seem like voodoo magic, and the idea of accounting just seems so foreign that it intimidates you. Well, but if you push yourself a little bit every time, those things that at one point in time seemed very intimidating won't anymore. The third thing that he talks about is having a mentor or someone that can walk you through some of these things. And I highly encourage you to seek that person out, whether you find that on the internet in the form of videos, whether you find that in one of the other franchisees in this room that you might hear and seem to have a grasp on this, or whether you find it somewhere else through maybe your accountant does your taxes at the end of your year. But I encourage you to find someone that you can go to and ask questions from. I do it all the time in my line of work. So that being said, I'm going to turn off the monitor here for a second and kind of move to a little mini TED Talk on a balance sheet. So I've got two boxes up here, and I want you to think of these as two sides of a balance sheet. And I don't want you to think of a balance sheet on a piece of paper. I want you to think of two scales, like Lady Liberty with both scales in her hands weighing something here. So on the left-hand side, we have assets. And I've got horrible penmanship, and I'm proud of it. You'll find out later today in one of the other TED Talks I'm going to have walk you guys through. It's all about a priority, and I don't make time to practice my penmanship. On this side, we have liabilities and equity. I'm not going to write these out, they're long words. So I've got an L and an E. So when you have a balance sheet for a business, on one side you have your assets, and this must be equal to your liabilities and your equity. And you may ask why, right after we watch this video, why I'm starting with a balance sheet and not an income statement. Because if I just took a show of hands, who feels more comfortable with an income statement than you do with a balance sheet? Balance sheet over income statement? Not many, yeah. No group I've ever presented to really likes the balance sheet. The balance sheet is my favorite document. I get excited about balance sheets. I think about balance sheets all the time. I live in balance sheets. You want to know why? Because an income statement is just a small part of your equity over here. Your income statement is actually part of your balance sheet. So why would you only want to look at a small part of your business when you've got all this going on in your business right here? And the really cool thing about a balance sheet is the balance sheet ties to your really long-term goals. When I opened with maximizing the amount of money that your business owes you over time and not running out of cash, you see that a lot more than you see it on your income statement. Your income statement is really your day-to-day, what's going on, how do I manage the small things. The balance sheet is much more long-term. All right, so let's now walk through the creation of a business, and I'm going to do it with some Monopoly money and some hotels. I know I've played Monopoly a lot. I've got some kids that love to play Monopoly. I know you have to start with greenhouses. You have to own all the properties in the color. You have to get 4 houses first. Trust me, I know the rules, and I'm going to cheat a little bit today. And just for imagery's sake, I brought a couple of the classic Monopoly icons. Do we have any favorites here?
Car.
Car? You like the car?
I want the car.
The dog.
I couldn't find the thimble, but this is like really typical.
Oh, my favorite.
We're always missing a couple, right?
They used to have a battleship.
The battleship, yeah. My favorite is always the hat, and I was going to go with that today, but I heard the car most loudly, so we're going with the car right now. So we're now, this car is leaving the garage and going to start on this journey of owning a business.
The engine just blew.
What's that?
The engine just blew.
The engine just blew, yeah. All right, so here's how we're going to start this deal. You have to put some money into this business, because this business, remember, it's not you. So you're over here, you're the owner. This is your business, it's not you. You're going to start this deal by putting some money into it. So you got $500 right here, hard-earned money that you've saved, that you are going to drop into your bank account here. So I got $500 in the cash bank account. Now, because a balance sheet must always balance, what do we have over here? We've got your equity. Now, this money doesn't hit your income statement. Remember, an income statement is only a small part of your equity. Your equity, really, this becomes your paid-in capital. Think of it as a loan that you gave to your business that your business is going to owe you in the future. Does that make sense? Right? So I've got $500 here that my business now owes me. So I funded my business with $500, and my business owes me the $500 back. I am not my business. Now, one of the first things that you need to do when you start your new business is get some inventory, right? It's really, I mean, unless you're just selling your service, which is possible, but you're going to need something to sell someone, so you're going to need to buy something, right? All right, so I'm going to play the bank here in Monopoly, and I'm going to swap out a $500 bill for 5 $100 bills. Everyone okay with that? All right, so we got that there. And I now have my inventory in terms of hotels. And each hotel costs $100. So one thing I could do is just take all 5 hotels there and pay $500, but what rule did I just break?
Out of
Right
cash.
out of cash, yeah. It seems so simple, and so many businesses do this. I was a banker before I was a CFO, and I can't tell you how many businesses would run out of cash, big, sophisticated businesses, because they bought too much inventory and they were sitting on inventory. It was really funny. Skiing is one of my great passions in life. It's where I go back and forth between my learning and performance zones. And we were stopping by this little boutique ski shop on the way home last night, and everything was on sale because we're getting towards the end of the main ski season. And my 8-year-old daughter was saying, "Dad, why is everything on sale?" And I said, "Sweetheart, they don't want to carry this inventory all the way through the summer into next year." And she said, well, why not? Why would they sell it for less when they can just hold on to it all summer and sell it next year for conceivably full price? And I said, well, most of their money in their business, this is a small business, almost all of it's in inventory. So they can't use that. It's locked up. You can't do anything with it. So really think carefully. It's one of my first lessons today in this TED Talk, is really think carefully before you stock your vans or stock your businesses or stock your warehouse full of inventory. Yes, you can get a great deal on copier paper, and yes, you can run your business bankrupt on copier paper. So we're going to actually back up a little bit here, and I'm only going to spend $200 on inventory, and I'm going to leave the remaining $300 in the bank. Hopefully you got my point there on the inventory. So now you can see I just did another balance sheet transaction, and it did not hit the income statement. Did you guys notice that? So it's a balance sheet, it has to balance. So what I did is I took $200 away from here, but I added another form of an asset in $200 in inventory. So I just had a balance sheet transaction that didn't cover both sides. It only covered one side, and that works because my balance sheet still balances. You guys all with me there? All right. Now we're going to have our first sale, and this is where it gets really, really tricky for a lot of people, and I hope to demystify this entire process. And I'm going to do this in a 2-step fashion. So you just sold something for $10. You with me?
Mm-hmm.
And now your business now owes you how much? $10 over here. Is it part of your paid-in capital? No. Your paid-in capital is separate money that your business owes you. Does your business owe you this money?
Yes.
Yes. So where is it hitting right now? Equity? It's hitting equity, right? And it's also
Yes.
part of your income statement. You now had $10 in sales. Does that make sense? So your business now owes you the $500 you have in paid-in capital, plus the $10 in sales that you just brought in. Do you see how your balance sheet balances? Make sense? Okay. Now, I'm going to leave the inventory where it is because I'm going to keep this really simple. Let's say you had to go to Home Depot and buy $5 worth of supplies to process this sale. Does that make sense? So now, out of your bank account, I'm taking the 10 and I'm taking 5 out of it for the expense, and I'm leaving 5 in here. Does that make sense?
Mm-hmm.
All right. So now, your business originally owed you $10, but you had $5 in expense. So now I'm going to take this 10 out and leave the 5 there. So my business owes me a net of $5 based on my income statement for the current period. So the $5 really started with a gross of 10 minus $5 in expenses is my net of $5. So at the end of the day, my balance sheet balances. I still have my $200 in inventory. I haven't touched that. I have my $300 in cash in the bank, which corresponds to my paid-in capital. And I've got an additional $5 here that was my net income for the period, cash in the bank, and net income that my business owes me. And this is why I think it's really important to separate yourself from your business. Think of your business owing you something. All right? Now I could keep repeating this over and over again and have a lot of transactions here that would build up for this current period for my income statement. But let's pretend the current period is over and it was really bad. So really bad as in we didn't make money, In fact, we used up all of our inventory, we used up our cash in the bank, and what we were left with is $50 in the bank. So your month started off great, you sold something for $10, your expenses were $5, you had a 50% profit margin, but at the end of the month, really ugly month, you only have $50 in the bank. So how does your balance sheet balance with that?
Liabilities.
It's really tempting, but no. I'm totally staying away from liabilities right now. Anyone ever heard of an IOU?
Yeah, give
This-
the guy a burger and he'll pay you Monday.
Yep. You now have an IOU for negative $450 for that period. So that period, your income statement was minus $450. So you still have this $500 in paid-in capital right here that your business owes you at the beginning. But your business,
I can't pay you.
right, your business can't pay you.
And then it takes $1,000.
There's a parable about this where someone goes to someone and says, I can't pay you anymore, and that debt is forgiven. But in business, we can't forgive those things, right? So you put in $500, your business has wasted $450, so you know what your business has in the equity section? Your business writes you an IOU and says, I owe you, Mr. Business Owner, or actually you owe your business $450 because you have to make up the shortfall for your business. Does that make sense? So now you are separate from your business, you owe your business $450. I said that backwards, forgive me. So how do you dig yourself out of this hole? Well, now that the next month starts, this becomes your retained earnings. Does that make sense? This now becomes your starting retained earnings. So you had a horrible month, you have retained earnings of negative $450, you have the $500 you put in. What's the net worth of your business right now? $50. It goes up, and my liability here goes up, and I can borrow that. And this is how a lot of businesses start up. Instead of having the owner put in a lot of money, the owner goes and gets a loan for the business. And that can be really dangerous because all of a sudden you can keep the cash going, right? Not run out of cash. But all of a sudden, what if your liabilities end up being huge right here and all of a sudden you can't make the payment? So I didn't bring the liabilities in until the end because of what I wanted to contrast was just managing your business based on cash and equity and a little bit of inventory over time. Liabilities can help you conserve cash. It's money that your business owes to other people. But liabilities in the long run, while they conserve cash in the short run, liabilities in the long run can starve you of all your cash because your business ends up owing other people more money than your business owes you. And that's how I'm going to close this portion of the TED Talk. When you look at this, you've got your asset right here. You can build this asset in two different ways. One, you can do what I've talked about for most of my TED Talk, which is increase equity. So you can grow your asset by putting money in or making money with your business. The other way you can grow your asset is by borrowing money from other people on this side. And that can be deceiving because all of a sudden your asset is growing. But if you go back to my original point that you are not your business, at the end of the day, when you're done with your business, say you're ready to retire, say you're going to sell it to someone, any of those scenarios, your assets are going to get divided up based on money that your business owes other people and money that your business owes you. Make sense?
Mm-hmm.
All right.
Which one of those takes the priority?
What's that?
Which one of those takes the priority?
Well, if you look at my goal here, to leave here, is that you want to maximize the amount of money that your business owes you and never run out of cash. So the whole point of owning a business is to grow this side, is to grow your assets, i.e. cash in the bank, by making money. I think you can really see that through this process. It's as simple as making money month after month and having that build into cash in the bank. There we go. My 3 commandments for pricing. Who can tell me the difference between markup and profit? Is there a difference between the two?
Yes.
What's the difference?
So markup is just marking up your product. Profit is what is made after, in your markup, you could pull out all of your costs.
Sure, and I'm talking about even a more fundamental. So it's a great answer. That's actually going to lead into my number 3 point.
Okay.
But this first point is something that's really commonly misunderstood. Because a 50% markup is actually only 33% profit. And I always like to think of this with $100. As much math as I have to deal with on a daily basis, I like really round numbers. So if I take $100 and I mark it up 33%, how much do I have? 133. So if my costs were $100 and I'm now selling it for 133, what's my percentage profit? It's a quarter. My percentage profit is a quarter.
25%.
25%. Do you understand what I'm saying? So your $100 is made up of 3/3. I added a 4/3, but my costs were $100. Does that make sense?
Yes, okay.
You get it? So a lot of times people think, oh, I'm marking it up 33%, my profit's 33%. No, it's not. It's actually only 1/4, it's 25%. It's even more obvious when you think of it this way. If I'm going to do a 50% markup, I would take $100, right, my cost, add 50 to it, but what was my profit there? It's 33%, right? Because my costs were $50. $50 is 1/3 of 150. So if you have a target profit margin, the formula for this is taking your costs and then you divide it by 1 minus the percentage that you want. So 1 minus 0.5, and if I divide my $100 by 0.5, I'm going to get the markup I need to get my 50%, or excuse me, my 33% or my 50% profit. That's what I meant to say. Make sense?
So you would charge 175?
Well, whatever you want, you end up dividing that number by. So you would take your cost, $100, divide that by 0.5.
Okay, so that's 50.
Right. And then you add that. 1 minus 0.5. A 35% markup. Bear with me while I bring this over. All right. So let's say you've got $100 in costs right here. And I'm going to use a more complex example. My business, we want to have a 35% profit at all times. We always want to have a 35% profit. So I'm now going to divide my $100 by 1 minus that 0.35, which ends up being 0.65. So if I divide this by 0.65, I now need to charge my customer that amount to get a 35% profit. Does that make sense?
Mm-hmm.
If I just multiplied my $100 times 0.35, I would charge them $135. That's the difference.
So where'd the 65 come from?
The 65 is 1 minus the 0.35. That makes sense? 1 whole minus the percentage in
and then
decimal
that's
points.
what's left over.
Bingo.
Okay,
So
got it.
this is my number 1 rule of pricing, is understanding the difference between markup and profit.
So a lot of people think they're charging 35% profit margin and they're actually charging.
Yeah, and they're getting about 26% if you're using my example. So if you come over here and use my example here and my mouse where it needs to be. So if I actually just marked it up by $35 and I divide this by 135, I'm only getting about a 26% profit. And even some of the most experienced business people that I see, not small business owners, experienced business people, get tripped up on this. They think, man, I'm making a 35% margin on this job. Well, if all you did was multiply your cost by 35%, you're really only making a 26% margin. So this is my number 1 commandment of pricing. The second is the impact of discounts. And I'll actually keep the calculator up. And I intentionally don't have slide presentations in which I have a lot of numbers, because what I find is that doing a live calculation is a heck of a lot more effective for someone than seeing me put numbers on a slide. So let's take a look at this. Let's say on an average week that you can do, that you've got 30 hours that are billable. Does that make sense? 30 billable hours, and you're charging by the hour, times 4 weeks in a month on average, you're going to end up with $120, or 120 hours a month that are billable. And let's say, again, for the sake of round numbers, we're going to multiply this times $100 per hour, so you're going to get 12,000 here, right? You have 120 billable hours a month, and you're charging $100 an hour. So what if you discount this by 20% and only charge $80 an hour? That you're trying to generate short-term sales by doing this. What's the impact to your business? Well, a lot of people don't always think that through. They just think, all right, I'm still making money at $80, but if I wanted to get to that same dollar amount, they don't always ask themselves, how many additional hours would I have to work? And the way that you do this is you now take this $12,000 and divide it by 80, and now you've got to work 150, or you have to perform 150 billable hours in this same period to get to that same amount. That equals to 30 additional hours in that month. Is that reasonable? And so I'm not telling you never to discount, because sometimes in some businesses you've got to show a larger amount and show a discount. I'm just saying understand the impact of that business, and you may need to inflate your original price before you show this one. And that sometimes it's a game that needs to be played. Much less do I see that in the service business, which most of you guys are in. Does that make sense? All right. My next point here, I'm just going to minimize this. My next point here is cover your overhead. And I think this was your real point, is that even if you're just marking up your direct materials and your direct labor, that may not be your real gross margin or your profit margin, Dave. Is that what you're saying? Because you've got all those other things.
Right.
And this is my third point, that there's all these hidden costs that a lot of business owners don't think about when they first get in their business. This could be your rent. This could be the interest on an auto loan if you have an auto loan. This can be your taxes that you have to pay that are like your business license that gets spread out over a year. I'm not really talking about the incremental taxes that are part of a transaction, but just your general taxes. This could be the cost of having a good bookkeeper, which I'll touch on that at the end.
Insurance.
Insurance.
License.
Vehicle insurance?
Yep.
Car repairs.
Yeah, so, yep, and that's actually
Oil
why
changes.
I brought in the chance cards here, and we reference
Clothing,
Monopoly.
shoes.
Yep, so I've got Community Chest and Chance. You guys remember how these work? You got some fun ones here. Some of the Chance ones go directly to jail. Hopefully no one in this room hits this, but how do you get out of jail in Monopoly?
Roll doubles.
$50,
doubles,
right?
nobody
Yeah,
paid for it.
unless you roll doubles, you got to pay $50, right? But then there are times again that you'll just find that you get a rebate or a refund on something, so that happens too. But again, I'm bringing these up more just the point that there's a lot of unexpected expenses. Right here, pay doctor's fee of $50. I had a kid break her shoulder skiing this year, and another kid break her tibia. I didn't plan for those things in my life. Those are expenses that I have to absorb. Your business has things like that all the time: fire, damage, theft, all those different things. So in addition to the predictable fixed costs that you have each month, you need to plan in some of those things. And most of the time what I see in a service-based business is that those costs get built into your hourly rate, that you have to price that into your hourly rate. Some people will also build it into a material markup, and you can do it that way, that every material gets a certain burden added to it that absorbs that. But at the end of the day, I don't really care how small businesses do it, but you need to really cover your overhead with the pricing that you have. So these are kind of my TED Talk on my 3 commandments of pricing. Questions on that?
As a banker, when you're loaning money to people, can you easily pick up that the business owner is missing on that kind of stuff?
Well, certainly I ask questions, and I've been out of that space for a number of years now, but one of my first questions is, why are you losing money? If someone can't tell me why they're losing money, that's a really big red flag. And as a small business owner, you guys should be able to know that. Did I have one big job that went bad this year, or am I consistently losing money on each job, and why is that? You know, make sense? Other questions? All right, we're gonna move into my little TED Talk on the 3 commandments of just regular accounting good practices. How many of you guys use QuickBooks or QuickBooks Online? Some variation thereof. All right. So really cool tool for small business owners. It takes accounting and makes it easy. How many people have it integrated with your bank statements and your credit card? So all those transactions pull in, right? Okay. How many people still end up having a little bit of pain with receipts that you pick up and getting those things in there? So if you're using a credit card, then a lot of times that will eliminate a lot of that pain. You still may need to hold on to some of those receipts, but at least those transactions will get into QuickBooks pretty easily if you're reconciling your transactions in QuickBooks with your bank statements. The final thing that I will say on that, though, is that paper becomes an issue for everyone. I think almost everyone here has a smartphone, whether it's Google or whether it's an iPhone. There are a bunch of scanning apps on this. Have anyone used those scanning apps?
They give us demonstration.
Not yet, but
Yeah.
Just picked it up yesterday.
My favorite is Cam Scanner, and it helps me, and we use it on our expense reports, our office, but this helps us get this stuff down to 0 daily. And the beautiful thing is if you've got QuickBooks integrated with your bank statements and your credit card, and you're using your credit card for a lot of purchases, then this helps you with the paper piece, and it gets it, yeah. But I can tell you that the principle of what goes up must come down is true, and it's true with business paperwork. The more that mountain builds, the more you're going to have to go through it, so find a way to do it daily. Now, I highly recommend that you do the third thing that I talk about, which is follow the cash, and I'm going to talk about that in 2 ways in a second before I wrap up this shorter TED Talk. But number 2 is really important. So when your credit cards come in, you do have a choice to lump those all into one transaction in QuickBooks, or you can break them out into granular ones. There are people that just go to the ends of the earth to be super detailed, and I really look at it in terms of value. Are you ever going to use that amount of data? And that's why I have an adage here: be as detailed as you need to be, primarily for taxes, but as little as you must. Because the more granularity that you create, the more classes you create in QuickBooks and try to code things, the cuter you get, the harder it is to really manage your money on a daily basis. I would think at this point in time, for most of you guys, you do not need to manage costs at a job or customer level, but if you do, know that you do have ability to do that in QuickBooks. You can create some classes and things in order to do that. But again, keep this in mind when you do your day-to-day accounting. Be as detailed as you need, but as little as you must, because detail creates a heck of a lot of complexity. The final thing is, once you've kind of figured out how to get your flow down daily, you use technology to do that so you don't have paperwork building up, and that you've got the detail piece right, I would encourage you as small business owners, before you fully outsource this to another bookkeeper, that you really have done it at least for a short period of time and you understand how the money flows through the business, similar to the balance sheet that I just showed you. Once you do that, I imagine most of you guys are going to end up outsourcing your cost to a bookkeeper at some level or some sort of third party. The one thing you need to always do in your business is follow your cash. The next part I think is really, really good, but for the scope of what I really wanted to accomplish today, I think you get my point. So why did I open part of my presentation today with this learning versus performance, and why am I closing with time management? Well, I can tell you, I have done a lot of learning related to finance, I've done a lot of doing related to finance, I've done a lot of teaching. And the biggest obstacles for people with finance have nothing to do with finance themselves. It has to do with the fact that there are blocks or the things that get in the way of actually learning and being able to assimilate new things, and it comes down to time. I've got so many people that tell me that the things that I've talked to them about in terms of managing the finances of their business, they don't have time for it. And really that's a way of saying, I don't have a priority. It's not a priority for me. But what I can tell you is, if you look at this balance sheet that I have, if you don't make time to figure out how to grow your assets through the equity side of your balance sheet, it takes time to manage your business and plan and price accordingly and do all the things you need to do so that at some point in time in the future, you hit your big picture goal, which is having your business owe you as much money as possible and not run out of cash. Grow this thing right here.